welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on growthy tech or innovation plays, and my guest is Satya Pradhuman, Director of Research at Cirrus. No fund exemplifies the innovation play like Cathie Wood's ARK Invest. The fund has lost more than half of its value this year as investors took a risk-off approach, punishing growthy tech names. These 10 stocks make up 60% of the portfolio. They include pandemic darling Zoom Video, along with Tesla, biotech firm CRISPR, and a smattering of crypto-related stocks, including Block and Coinbase. And instead of reducing its risk appetite, the fund has doubled down over the past year, increasing its holdings in Zoom as well as Coinbase, even after those stocks plunged. Well, for more, I'm now joined by Satya Pradhuman from Cirrus Research. Satya, hi. Thanks for joining us. Do you think these stocks are around rock bottom now, or is there more to fall?
Well, I think we've seen a dramatic correction in the last 12, 18 months. And I think we're a lot closer to a bottom among the smaller innovation shares. I'm really glad you're sort of calling out this distinction in the growth stock market. That's one of the items we focused on quite a bit in the last year, which is to separate between quality growth stocks and innovation growth shares. And as a result, what we have seen is a pretty large bifurcation in performance, where the sort of speculative high-octane growth companies, they took to a rise as the Fed really added liquidity to the system, and equally reversed really from basically the start of last year. And so what we're now starting to feel is that pinch getting to more of the larger mega cap growth stocks. So if you separate out the space, we've seen a lot of damage take place. We would use valuations to sort of assess how far it's run. The Cathie Wood's product, as an example, had climbed to an all-time peak of about 15 times EV to sales. Bear in mind, this is a range that used to be between 3 and 6 times. And in the last 9, 12 months, it's corrected back to about 4 times. So we're getting there. A lot of speculations have been priced into these shares.
In other words, then, you think this is a pretty risky time to be concentrating many holdings in these sort of innovative tech stocks?
I still think the risk lies among the larger names, because there's a couple of things going on here. The Fed's not done. So the unwinding of the liquidity moment, it will continue. And it's really hard to see investors at this point chase these names to find a bottom. What we've been recommending is to focus on the other parts of the growth market. And so, for instance, you can look to more visible earnings, dependable earnings from healthcare, from consumers. It's not only a one stock market. And I draw this linkage back to the 2000s. You had the internet bubble implode. And from 2000 to 2005, a whole bunch of sectors rotated and worked favorably. We don't have to go right back in.
When you say the Fed is not done with tightening, are you expecting this to pull down large cap tech further as we go forward?
I think it'll continue to depress share prices. It's forcing the investor community to really draw in their attention. Instead of promises of the long run, they're looking right now for cash flow and earnings visibility. And this is a wonderful strategy. This is not a bad thing. It's just that we've been so trained to go after very, very aggressive growth companies the last few years, as effectively interest rates were zero.
Can I ask you a last question, Satya, on cryptocurrency, which of course is a key part of this sort of innovative tech funds like ARK. How would you advise investors to approach the crypto space?
I think we've done some work on this. You can look at the crypto markets, you can look at SPACs, you can look at NASDAQ, you can look at the ARK product. They're all trading the same way. In other words, speculation, cheap money is fuel for speculative stocks. If that's unwinding, all of these groups are going to move together. There's good technologies there, but I think we're going to watch this sort of unfold. And I do think the earnings season's here. The banks are going to struggle in this reporting window.
Thanks so much for that, Satya Pradhuman, Director of Research at Cirrus. Well, before I go, here are some of the stories we're following in this space. Sources have told Reuters that Chinese regulators are getting ready to fine Didi Global more than $1 billion, bringing an end to a year-long probe into the ride-hailing app's cybersecurity practices. Settling the dispute would push Didi to kickstart a new share listing in Hong Kong after delisting from the NYSE last month. Chat platform Slack says it will raise prices for its platform, the first since the workplace messaging app launched in 2014. Slack is owned by Salesforce and is now a common tool used by many companies. The company says it will use the price increase, about 75 cents a month for a pro subscription, to invest in more innovation. And British online furniture retailer Made.com cut its sales guidance for this year and said it does not expect an improvement in demand for big-ticket items anytime soon. Confidence levels among British consumers sank to a record low last month as they struggle with a cost of living crisis. And that's your roundup of innovative tech. I'm Elena Casas, and this is Reuters.